Welcome back to the Mortgage Reports. Today we're taking a closer look at a topic that many homeowners don't realize is even an option: the HECM refinance. If you already have a reverse mortgage or you're considering one in the future, this is something that can open up new financial opportunities, give you access to more equity, or even lower your borrowing costs. A HECM-to-HECM refinance can be a powerful tool, but only when you understand what it is, why someone would use it, and what it means for your long-term financial picture. So in this video, we're going to walk through exactly what a HECM refinance is, who qualifies for it, what the costs typically look like, when it makes sense to consider one, and what it looks like in the real world. So let's jump into it. Question 1. What exactly is a HECM refinance? Well, a HECM refinance is simply a way of replacing your existing reverse mortgage with a new one, usually to unlock more equity, reduce your interest rate, or update your loan terms. It works a lot like refinancing a traditional mortgage, but instead of switching from one forward loan to another, you're refinancing one reverse mortgage into a new reverse mortgage. Many homeowners choose this option because their home value has gone up, they're now eligible for more funds, or market conditions have changed in their favor. It's essentially a chance to reset the loan so it better matches your current financial needs. Question 2. Who is eligible for a HECM refinance? Eligibility requirements are very similar to those for a standard reverse mortgage. You must be at least 62 years old, live in a home as your primary residence, remain current with property taxes and insurance, and keep the home well maintained. You also can't be behind on federal debt, but there's one additional requirement specific to refinancing. You generally need to qualify for a meaningful increase in available funds. Now, lenders look at your home's updated value, the current interest rates, and the amount you've already borrowed to determine whether a refinance provides a real benefit. Now, in many cases, rising home values or changes in FHA loan limits are what make a reverse finance well worthwhile. Question 3. What are the benefits of refinancing a HECM? Well, one of the biggest advantages is the ability to access more of your home equity. If your property value has gone up over the last several years, a refinance can unlock additional funds you weren't eligible for before. Another benefit comes from potentially lowering your interest rate, which can slow down the rate at which your loan balance grows. Now, some borrowers refinance to switch payout options. For example, moving from a lump sum structure to a line of credit that keeps growing over time. Others just want to reset their loan terms or add a spouse to the mortgage so both partners are protected. Now, overall, a HECM refinance can be a flexible way to realign your loan with your retirement goals. Question 4. What costs should homeowners expect with a HECM refinance? Just like any other refinance, there are closing costs involved. These may include lender's fees, title and escrow charges, mortgage insurance premiums, and appraisal costs. Many of these expenses can be rolled into the loan, so you may not have to pay anything out of pocket, but it's still important to understand how they affect your available equity. The good news is that homeowners who refinance an existing HECM often benefit from reduced upfront mortgage insurance premiums because they've already paid them once. Still, the total cost depends on your home value, location, and loan structure, which is why a detailed loan comparison is key before moving forward. Question 5. When does a HECM refinance actually make sense? A refinance tends to make the most sense when it leads to a clear financial benefit. Whether that's more available funds, lower interest costs, or better long-term flexibility. For example, if home prices have risen significantly since your original reverse mortgage, you may qualify for access to tens of thousands of dollars more. If interest rates have dropped, you might save money on your overall growth of your loan balance. Now, some borrowers choose to refinance when a spouse who wasn't originally on the loan is now old enough to qualify. Adding them can ensure they're protected as an eligible non-borrowing spouse. And in some situations, homeowners refinance simply because their goals have changed and they now want a different payout method or a larger line of credit. Question 6. What does the process look like? Well, the refinance process is very similar to getting a new reverse mortgage. It starts with a conversation with a lender to determine whether you're eligible for additional funds or improved terms. You'll also need a new appraisal to confirm your home's value and a counseling session with a HUD-approved counselor to ensure the refinance is in your best interest. Now, once all the paperwork is complete and the loan closes, the new reverse mortgage pays off the old one automatically. Any extra funds you qualify for become available either as a lump sum, monthly payments, or a line of credit, whichever structure you choose. For most homeowners, the entire process takes about a month, depending on how quickly everything is completed. So, real life examples. Example 1. Eleanor, age 73, took out her reverse mortgage years ago when home prices were much lower. After seeing her property value rise substantially, she refinanced and gained access to a larger line of credit. This gave her more flexibility to cover future medical expenses and home repairs without relying on other savings. Example 2. George and Diane originally opted for a lump sum payout when they got their reverse mortgage. A few years later, they realized they wanted a more flexible setup. By refinancing, they switched to a growing line of credit, giving them ongoing access to funds whenever they needed them, and helping their available credit increase each year. So a HECM refinance can be a smart move when it supports your long-term financial goals, gives you access to more equity, or helps you secure better loan terms. So just to recap, it allows you to replace your existing reverse mortgage with a new one, and you may qualify for more funds, better flexibility, or lower interest costs. Now, you must still meet basic reverse mortgage eligibility standards. And it's worth considering when home values rise or your needs change. If this video helped you understand how a HECM refinance works, give it a thumbs up, subscribe to the Mortgage Reports, and hit that notification bell so you don't miss future videos that break down important housing topics in simple, easy to understand language. And for more examples and guidance, check out the full article linked in the description. Thanks for watching, and I'll see you in the next one.